All right, welcome to the Real Estate Rundown. Chris and Renee here with you guys again, and we are super excited to present today's content. Just remember, please like, share, subscribe. We really rely on you guys to spread this local content so that we can make sure to be helping folks into their housing dreams here in Northern Arizona. And so, Renee, you were talking, to kick this right off, we love to talk about these hot topics that are spinning and myth, break, or bust. Or was it myth, make, or bust? Break? Make or break. Myth, make, or break. When people are wondering on assumptions. I've had a couple people talk to me about a loan assumption. You've had a couple people. So let's go into that. What kind of questions are you getting? And tell us what you understand on that.
Well, I've had a lot of people kind of hear rumblings of what loan assumptions are and thinking that, hey, this is something that we should really be looking out for. So why would somebody want to assume a loan? The obvious reason is that you would assume a lower rate, which is great. The second would be the cost is significantly lower than originating a new loan. So you're looking, maybe $500 to assume a loan?
Can vary on the servicer. But yeah.
So,
you're talking hundreds of dollars versus, potentially thousands of dollars originating a new loan.
Right, which are great points. The key here is that only certain loans are assumable. So each loan type has their own loan guidelines on assumptions. Chris, can you tell us a little bit about each of those?
Yeah, so like you were saying, Renee, so you nailed all those points, right? Government-backed loans, and so FHA, VA, USDA. The kickers on some of these, though, right, is there's some pros and cons here. The red tape on it is FHA is the most open to like occupancy types, right, and qualification on that. Like if you're an investor and you want to assume an FHA mortgage, you can do that. And you just basically, the seller's going to connect you with their servicer. You'd qualify to take over the debt, and you can take over that debt. You are keeping that mortgage insurance, right? You can't take the rate and not the mortgage insurance. So you're taking everything from that loan. And if you have a $450,000 assumed loan, and you're selling the house for $600 or $600,000, you're going to have to pay that gap. Right. So that's some things to think about on that FHA factor. On the VA front, what's really nuanced about that, right? VA loan being originated to a veteran is if you are a veteran assuming that loan as a primary residence, then awesome, right? Because what veterans have is they have a certain amount of entitlement, and the new veteran or the veteran buying the house will be able to take it over with their entitlement, assuming that they have eligibility, and take it on as a primary loan. So the only thing that then is tricky with that one is them coming up with that gap from sales price to the loan, right? If it is not a veteran, so if they're buying it as a second home, investment home, or just not a veteran buying it as a primary home, it's kind of a big bite off for the seller, because the seller is going to lock up their entitlement, meaning that they can't just go and use their VA loan again on their next move. And if that buyer that's not a veteran forecloses on the house, that veteran could lose their entitlement forever. So they're kind of still tied. That's the beautiful thing. Typically in the assumption is you get to give your mortgage away and move on. But with the veteran, there's some potential strings attached. And then USDA, you have to qualify for USDA, a loan program, which has income restrictions and different things attached there. So so there's a little bit more red tape.
So I think to kind of sum everything up is, yes, it's doable, and we do see them come up here and there. We didn't see a lot of FHA, VA, USDA over the last 3 years because the market was so competitive. So a lot of the loans that do have those lower interest rates are conventional. So just know that as your professional, we're going to be keeping an eye out for things like this, opportunities where you could snag something along these lines, but they're just not readily available at this time.
Yeah. And have you been seeing much of, and actually real quick tangent on this, we hadn't talked about this before. So have you been hearing about subject to financing?
Not much.
So, and I'll be careful on that. I'm not a super pro, but I have been seeing certain things on the interweb about this. And actually even the Wall Street Journal published a couple weeks back that there was a company that was coming in to help people with loan assumptions. And really, if we think about it, the massive subsidy that was given with interest rates being as low as they were and people wanting to tap into it, like I can't fault people for wanting to get in on that gold mine.
Right.
But there's some other companies out there that are basically putting it together where they're saying, hey, this is slick Rick, get rich fast kind of guys, right? Of let's go. We're going to just take over the deeds. on these.
Right.
And I'm probably, hey, put in the comments if I'm totally misunderstanding or misrepresenting this, but what happens is there's a due on sale clause. If that deed changes, that the mortgage company is going to or reserves the right to say you need to pay off this mortgage because we didn't qualify you, not the new buyer, John Smith.
Right.
And so be careful on anything you're researching out there on the internet. There are some very strict legal ways on how it maintains the housing market integrity. So careful with some of those other things outside of assumptions.
Yes. And just know if it sounds too good to be true, it might be too good to be true. So talk with your professional, talk with us, and we're happy to kind of guide you and answer any questions about it.
Actually, perfect segue into then, as we talk to you about something that sounds too good to be true, 4% interest rates in today's market and 4% APR. Do it not a 4% APR, and that's what we'll talk about here. So buy downs.
Right.
You don't have anyone talking or any clients talking about buy downs,
Very
right?
few of them.
Okay. So that's what I was, you and I were talking, Renee, that there's very specific market conditions in which certain opportunities or creativity works, and then certain opportunities, like we just talked about with assumptions, where it might not work as well, right? So most folks understand, well, if we're talking about, let's preface this the way I want to, I guess, frame this is I've had a lot of buyers say, I wish the seller could just, give me their lower interest rate or help me with the lower interest rate or do something. And when it comes down to, if a seller's going to start throwing money at you, we haven't been really in that market until fairly recently.
Right.
That we're seeing not 50% off the house, but we're seeing, what are you seeing generally? I mean, not to put you on the spot too much, but are you seeing some loosening up there a little bit?
I am. I think for a while, sellers were having a tough time grasping that the market had changed and things have shifted. But I think, what did we say? It kind of felt like in about August, things started to catch on a little bit more. So negotiations became a little bit more, there's a little bit more back and forth. Prices are going down, repairs are happening. There's more expectation from the buyer that the home is in a certain condition and that numbers hit certain areas. So it's interesting. Yeah.
And that's where I think, not to speak outside my area of expertise, but I think we're kind of seeing a double-edged sword, right? In seasonality returning back to the market. We've talked about this, right? Usually you'd see August, late summer is kind of when other people are moving on with life and the seasons and the school and different things where we see that softening, as well as then these interest rates didn't give us any breaks and they spiked again, right? And so that's where, with those market conditions occurring, seeing a little softening in prices right now, I'm going to talk to you about a creative tool out there that may sound too good to be true. We'll talk about the caveats to it, but it really is an awesome, awesome tool. And it's called a temporary buy down. And so I'll have Cole put this up on the charts here. So what you're seeing here, and because I want to mathematically explain this, if we look about, I know the median price is maybe a little higher than this right now, but like 650-ish purchase price, 20% down scenario. If that's where the seller was starting, or the seller was starting at 650, they weren't offering you anything, but now their house is sitting for a little bit. If you said, okay, Mr. and Mrs. Seller, can you sell me the house or give me some type of discount, throw something at me. If the seller was willing to do upwards of, to get you $1,000 less payment, let's go from that standpoint. Okay. If the seller said, hey, because buyers are payment sensitive right now, it's all rate driven, right? 80% of buyers ish, 75, 80% are financing. So if they said, hey, I will reduce my price by $175,000, you'd save $1,000 a month. And you're laughing. Why?
Because it's massive and it's not going to happen.
So when you say prices are reducing, it's not by that
much. Yeah, exactly.
But 30,000 is maybe more palatable.
Very much so.
I'm seeing that. I'm seeing people throwing on some concessions or a little bit of price reduction or a little bit of both. So in this chart, what you can see is that column too is saying, hey, if they drop by 175,000, now if they've dropped by 30,000, that's only about $170 a month. Right. Not a big dip. If they just drop their price by 30,000, which is what 90% is, or I don't know, we're making up stats here, but most sellers, you see it, we all look online and you see price reduced, because they think, hey, price it right to sell.
Exactly.
But if we then went with so if they said, hey, we're going to pay money to contribute to your interest rate, and some, a little more savvy sellers and their listing agents are saying, hey, the client's rate sensitive, let's get that rate down. If they put $30,000, which on a 650 purchase price is about 4.5, 4.6%, towards a permanent rate buy down that's only going to get them about 1% lower in interest rate, which, as you can see in the third column here on the chart, is going to save you $350 per month. So, hey, that's better than saving $170 per month if they put it just on a sales price. But the third column, so let's get into this. The one word you're not going to like is temporary, right? And then we go back to like the bubble burst and everyone says adjustable and temporary, freaks them out, right? And they think like foreclosure, mom and dad losing the house, right?
Yeah.
And so let's break out the stigma here. So what this is that the seller can offer to offset, it has to be paid by the seller, can offer to basically directly offset your interest over a certain period of time. What I have here on the charts, guys, this is a 3-2-1 buy down. There are 2-1 buy downs. There are 1-1s, 1-0s. What that means is basically for the first year, your interest rate will be 3% below your actual rate. Then 2% for the second year, and then 1% below for the third year. And then the fourth year, that will go. And this is based on the time recording, these lovely 7.6%, ballpark 30-year fixed interest rates with the APRs listed there as well. So what you're seeing there is that you can actually start with a 4.625 rate today. Can actually do that. This is not too good to be true.
Right.
Now the cap, people are saying, well, I don't like the fact that it adjusts, but it still is a fixed rate. It will be at 7.625. If you never refinance, rates never come down, then you will be at that rate for the remaining 26 years of this mortgage, right? Or 27 years of this mortgage. And so the cool part about it though, is when if you do a permanent buy down, that money is dead and gone. But we were just talking about it is that, about 30-ish grand that the seller would be paying to do this particular program. The first year, that's about 15% interest because the rate starts lower. So it's $15,000.
Yeah.
Thank you. $15,000 worth of interest they're offsetting. It's about $10,000 the next year and about $5,000 the year after that. And so if you refinance, because we generally believe rates are going to be coming down, we just don't know when. So it gives you a pretty big window of 36 months with a lower interest rate than market. But if you refinance in 12 months from now, you would actually get $15,000 back to you. So that money, you could then pay down the balance if you want to of the mortgage. You could invest then in a lower permanent buy down rate if you wanted to. Basically, that money is yours.
And correct me if I'm wrong, but it's basically that money's sitting in an escrow account.
Correct. That each month that you're not paying, right? Because we're not in these super low government subsidized rates, but you can do basically a seller subsidy. So they put that money up. It's dead and gone to the seller, but it's your money that you're using to offset your interest each month.
I think this is something that we have to be utilizing.
Yeah. Please, if you're looking, please comment and let us know. What do you think about that? Does that seem scary? If you understand the terms, a lot of folks were already trying to wrap their mind around buy now and refi later. And if the prices are good now, is that worth carrying? But now you can buy now and actually get that little kick from the seller, little hitter from the seller to ease the burden of that payment while you wait for that lower interest rate.
Right.
So I don't know. And like I said, there's that's a big chunk of 30,000. If it's a tighter negotiation, the seller can just kick in a 1% and buy the interest rate down for 1%. Even, so we can go into the math. I know your maybe heads are spinning a little bit here, but yeah, they can kick in a little less and have a little less benefit, but it's still, a 1% lower rate could be, depending on the scenario, still, like we're seeing here, that's $350 cheaper per month. You could have that for 1 year and the seller only has to kick in 1%.
Yeah. 1% is huge right now.
Yeah. Yeah. Folks, we were kind of complaining about the 6s in the summer and now we wish we were back there, right? So yeah. Any other thoughts that you have on the buy down?
No, I think just ask the questions because obviously this is something that not a lot of people are talking about, and we can kind of pick and choose good scenarios to be using it. And so just ask the questions. And if it makes you nervous, then, we'll just talk through it.
Exactly. Yeah. Love it. All right. And I'm excited about our guest.
Yeah.
So we do have with us, and he's been hanging out for the conversation there. We have with us Eric Fernandez, a local financial advisor. And so different markets, right? Different conversation, but so much going on, right? With Fed concern, with what's going on with the markets. We just thought it would be great to have Eric come in, as it's a different perspective here. And Eric, why don't you kind of give us a synopsis on what's happening in your world, how that, you and I talk about it all the time of hey, how is this impacting interest rates? But that's a whole nother ballgame, and how different market events right now are impacting returns investments. Eric cannot legally give you financial advisement right now. Call his office. He'll help you there. But yeah, what are you seeing out there, Eric?
Well, before we jump into that, what I find really fascinating, just being a fly on the wall during your conversation, is the amount of strategic financial planning that y'all are doing in your side of the market. That was a strategic financial planning conversation, which is critical in any form of investment, in any form of portfolio management, in any form of financial goals that involve the acquisition of assets, which is what a house is. It's an asset. And we were talking about it earlier. You guys were just talking about it recently, about how people do become price sensitive, but you can't forget the fact that a home is an asset that is adding to your net worth, adding to your future financial value, and should be viewed as an investment. But the beauty of it is it's an investment that you can live in with your family. You're not going to live inside Amazon stock. My wife lives inside the Amazon store, but you're not going to actually live inside Amazon stock, right?
Yeah.
So, to that degree, one of the things that we had discussed earlier today as well is this idea that it's not just the market. It's multiple markets. We have the real estate market. We have the stock market, the bond market. And when you look in the stock market, there's different indexes within that market. And what we're finding today, what we found probably about a year ago, last time Chris and I had a conversation like this, is that consumer sentiment around the markets are still pretty low. A large portion of that is because of what's happening in current events around the economy, with inflation still hanging around, albeit significantly lower than it was before. It's at 3.8% right now, whereas it was at 9% last September. But with the increase in oil prices, a few other factors, inflation has picked up a little bit higher than where it was previously. Yet the Fed is still targeting this soft landing with interest rates.
Real quick there, so you put that, not to interrupt here, so you put that in air quotes, if you can see that. Help people understand that too, because I don't know, not a lot of people are paying very close attention. So what is a soft landing?
So a soft landing is the Fed avoiding a recession. That's really what it comes down to. We have all been squeezed by the increase in rates. We are feeling it in mortgage rates. We are feeling it on our credit card rates. We are feeling it on auto loans. That's the whole point of raising rates. It makes life more expensive, makes it harder for us to spend money, therefore brings costs down because there's not as much free cash to be spent. People aren't as liberal with their dollars to pay more for things if all of a sudden the rate on debt is significantly higher. And where that really comes from is the Fed funds rate is the rate at which banks can lend money to each other. So banks have to have cash reserves on hand at all time. And if a bank is low on cash reserves, they will borrow money from another bank, or maybe they'll borrow it from the Federal Reserve itself. Well, they're paying interest on borrowing that money. Banks are for profit. I hate to break it to y'all, but that's a business. They're not just an altruistic institution. So if they're going to be paying interest on something, they are going to charge us more interest than what they're paying. And that's where the whole trickle effect happens. So raising rates the way the Fed is doing it is candidly a very blunt and bloody tool when it comes to our economy, because they are slowing down the economy. An economy that's slowing down could slip into a recession. When they use the word soft landing, they're basically saying, hey, we're going to do this without causing a recession. And candidly, the Fed right now, we were talking about earlier, it looks like they're patting themselves on the back, even though we're not out of the woods yet, because they just raised their GDP expectations from where it used to be for the upcoming quarters, which is signaling that the Fed is saying, hey, we're going to achieve this soft landing. Recession shouldn't be a very scary word, but I'm not going to believe it until I see it. And I don't know if you guys have thoughts on that as well, but
yeah, and so that's what's really interesting when we talk about, I think the focus that we like to often relay to folks is that, and much like you do with your clients, Eric, is we can't look in the future. We truly don't know what's going to happen, but we can look in the past as the best indicator of what could happen, right, under certain market conditions. And generally speaking, at least in my world, so I'll speak to my world. Mm-hmm. I know we overlap all the time as we are very interested in, especially in the real estate and the mortgage side of things. Interest rates typically go down for mortgages when we are in a recession. Usually, just like we saw in an extreme example, during the brief recession of 2020, or that we saw the subsidy. You get the subsidy kick on. And we usually see policy lighten up or subsidy or different things occur to where it becomes a favorable interest rate environment.
And using 2020 as an example, I think that ties it back to the original point. I kind of went on a tangent there around interest rates. But this idea that we had initially shared about how there's different markets, different ways to view your assets. And this golden word that every financial advisor likes to use is the word diversification. So how can you diversify your real estate into the market, or into the stock market, bond market, whatever it might be? How can you diversify your liquid investments into real estate? That's conversations around the strategic planning, much like what you guys were sharing earlier in the show. And when I think about where the market's at right now, the market is actually following historical norms in that markets are positive 75% of the time. So that means every 4 years, there should be a negative market. And if we look at the past 4 years, 2020 was positive despite that 180-day recession. 2021 was positive. 2022 was negative. And hey, guess what? 2023, we're positive. Though we haven't recovered the prior high from last year at the beginning of the year, we are actually in a positive market right now. And when you think about real estate, 2008, great year for all of us, right? Real estate plummeled, the stock market plummeled. How long did it take for real estate to recover after 2008?
What was it like?
Once we got to it was like 5 years.
That's what, yeah.
Yeah.
Stock market was 18 months.
Right.
2020, stock market went into that deep dive again. It was short, but look what real estate did in 2020. Y'all skyrocketed. It was a great time to be diversified in different assets. And then the other thing you think about too is this whole idea of buy low, sell high. So buy low, sell high. If the market's still trending negative, or if the market's still positive, but it's not at its prior high, it hasn't started expanding yet, that's a great time to invest money. Well, when you think about real estate in a competitive market when it comes to interest rates, where people are being priced out of the market, don't you think it might be a good time to buy real estate because you're not having to buy $50,000, $100,000 over asking price like folks were having to do prior? You're removing the competition, creating strategic plans where you can structure that payment, and now you have a hard asset that can supplement your investable assets as well.
And I was just nailed it.
Exactly. And so mic drop, and in the sense of, as you were talking through that, and I just think it's a matter of, and I saw this little meme of basically saying that you wouldn't play a Monopoly game and just be the person that gets to collect $200, pass go, and try and avoid jail. That doesn't invest in anything, doesn't put anything out there. And hey, I am 100.
And pay rent.
Yeah. Oh, and I'm 100% sensitive to the folks that, are right now in this economy are just getting by. Right.
Yeah.
And that could be a lot of us, right? Of people just trying to get through this tough economic pinch of inflation. All of a sudden they're talking recession, and jobs are being lost, and it's really, really tough right now for a lot of people. But at the same time, I do see value in being able to take life not too serious, in the sense of you have to open up to a little bit of risk. Right? Putting yourself out there, investing in something, talking to real estate professionals, seeing, can I own my own home? Talking with a financial advisor. And you and I were talking, Eric, just barely about the one thing you have up on us, right? I tell you all the time, like, housing beats you. We add more net worth to people nationally because that's a lower risk, right? So the house over their head is what they perceive as lower risk. They're willing to make that mortgage payment and stuck on making that payment because they've been trained to pay rent anyways, right? Whereas your world is a little more foreign to people. So guys, jump into that world. There's benefits for sure. But the bottom line there is that if they can gamify it a little bit, if they can say, hey, or liquidity, is that's what you're talking about, right? Is that homes, if you said, hey, is this the time in the market and we're going to jump in? Well, if that's really the home, then great. But if it's not, what is your money doing for you anyways? How can you then see what are my options and opportunities? Maybe, like you said, with diversification, don't put your eggs all in one basket, right? If you
keep cash on hand, keep your savings.
Yes.
Savings is first, right? That's the most liquid thing you have because that's not going to lose value.
I can't tell you how many people, and actually real quick example, that I had some people in a tough pinch They'd sold a home, bought a home, put everything from that past home into the next, right? They want the lowest possible payment. And, you know, some certain life events and things don't go their way, and they have a short-term monetary pinch that otherwise could have easily been handled with cash on hand. Yep. Right. And that's where I think, you know, talking with the multiple professionals, but with a financial advisor and saying, where do we keep a little bit of nest egg? Because you never know if you're going to use it, because we can't predict the rainy days.
Right.
And I think we've talked about this, and to kind of go back to that, just so people fully understand, you may think you have to put 20% down. You may feel most comfortable with your payment if you put 20% down. Maybe you put 10% down, keep half that money in your pocket. Yeah, you're going to have a larger payment, but you're going to have a lot more cash on hand to make that payment and then anything else that pops up.
So Eric, Renee, kind of any other closing words on the rundown of things that people could, I mean, honestly said right now as we head into the holidays, you know, once the turkey hits the table, people's minds go into like just close out the year mode. So what should people be thinking about through the end of the year here?
I think the end of the year mode's okay. It's been a pretty hard 2 years for a lot of us. Things have been expensive. The economy, it's been unpredictable. So I would say enjoy the holidays with your family. Enjoy life a little bit, right?
I do love that. But also, if you are thinking about things and if you kind of want to maneuver some things, I think just explore them. Take that opportunity to kind of think through some possibilities.
Yeah, I would agree. And not counting out, your ability to step up to this game, right? And again, not to be insensitive to that, but I really think a lot of people like to count themselves out or think that you have to have this big war chest to participate in even talking to a financial advisor or thinking about buying a home. But no, with the right tools and resources, you can participate and you can grow your wealth and you can own your home. And so, yeah, maybe that's our message.
I like it.
Thanks for watching, you guys. And we'll look forward to next month's Real Estate Rundown.
Thank you.